Good morning, Facebook. Hope you're well on what is a very hot and muggy morning here in my trading room. Hope you are doing good. I said those words yesterday. I said them last night, 8 o'clock. I said it's too hot. We were doing a room session last night and I said those words that no Brit should ever say during the summer, which is it's too hot. We moan most of the year that it's cold, and then when it gets warm, we say it's too hot. So anyway, I expect it's going to be another day like that. It's very hazy outside. In terms of trades, we're quite busy at the moment. And I had a question last week. This was sent through from one of our free members. And it's a question I get a lot, and this is what I wanted to cover today. So one of the things people will ask me on a regular basis is, what can I expect to make from my trading? Now, the challenge with this question is it's quite broad, and actually what you've got going on here is probably 2 or 3 questions. Is initially people are asking to get an expectation, because if they're going to put their time, their energy and their money into doing something, they want to know what they're going to get back in return, and that makes sense. Sometimes it's slightly more external and they're asking, what can I expect to make from your strategies, or what do your strategies make? But for me, the question itself is too broad, and what somebody should be thinking to do is be a little bit more strategic. So when somebody asks me that, I will always ask somebody back, well, what is it that you want to make? Because the challenge is you can have very successful strategies that can be performing very, very well, but the challenge with those strategies is they don't meet the expectation of the trader. Very simply, if a trader wants to make 50% return a year, and that's their goal, and that's what they want to achieve, let's say over a 5 to 10 year period, but the strategy that they're trading is making 15% a year. That 15% a year, based on the fact they could be trading once a month or twice a month, is actually an extremely good return for the strategy that they're trading. And in terms of the time and money and energy they put into it, that's great. But because it doesn't meet their expectations, they're not necessarily, one, going to be happy with that strategy, or they are more likely to try and fiddle with the strategy or meddle with it or change it, or maybe even over-optimize it. And as a result, they end up doing often worse than the baseline performance because they've tried to make the strategy or the combination of strategies make more. So I think it's really, really important to ask a different question, which is, number one, what is your expectation? What is your goal? What do you want to make? And then, this is the important question, what capacity do those strategies have to deliver on that? And what am I, or what are you going to have to do that? So if we start with our beat the bank strategy, our beat the bank strategy, tested over 20 years, makes an average of 18% per year. And we'll come to the importance of the word average in a second. So it makes 18% a year tested. We have traded that live as a global community for 3 years and I think 4 months, and it's currently sitting at 66%. So you average that out, it's 19.9%. So the reason I'm giving you all these numbers and throwing these out there is you can look at that strategy and go, over a 20-year tested period, it makes 18%. We're currently at 19.9. So if you have an expectation to be trading once a month, which that strategy is, putting in about half an hour's work, risking no more than 2%, your average expectation can be, if your average expectation is 15%, that strategy meets your expectation. But if your expectation or the goal that you want to achieve is 35-40%, you need to be doing more than that. So that strategy works exceptionally well for the time and the effort that you have to put in, but as I've said, if it doesn't meet your expectation. So it's really important to think about what you want. For example, all 6 of our swing strategies over a 7-year period compounded, risking 1% per month, have made 1,700%. But if you come in the first year and you expect, as a result, you take that 1,700 and you divide it out, or you don't do the maths correctly, you can come into that scenario and think you're going to make 300-400%, and in that year you only make 50 or 60. So the really important thing, as I've already said, is think about your expectation versus what the capacity for those strategies have, and then think about what price do you have to pay to do that. What I say to students is always think about the price you've got to pay to be able to deliver on that strategy, because it could be a price in terms of time. You've got to learn the strategy, get used to it. But what that does is it forces you to think about one of the most important factors, which a lot of traders don't talk about because it's not sexy, it doesn't get bums on seats for training courses, it doesn't fill rooms. But what's really important is to think about the drawdown. So I say to a student when they're looking at it, yes, look, this strategy or these two strategies make 50, 60% per annum. But what you should be asking is, what price do you have to pay in terms of time and energy to learn them? But also, regardless of your skill set, there is going to be a period of time, if you're trading a strategy for a year, 2 years, 3 years, 5 years, 20 years, there are going to be multiple periods of time where you're losing. For example, one of our newer swing strategies that had a 70% return last year, I actually ended up with 68% on that. At the moment, it's going through a drawdown period. It's having a losing run. But one of our other swing strategies is steadily ticking away and is hitting a really good run at the moment. So if you're the trader that trades both, you're going to be about even Stevens, probably slightly up at the moment. But if you're the trader that is only trading the losing strategy, and you started that strategy 3 months ago, you're going to be hitting a bit of a drawdown. But the challenge is a lot of people will take their long-term expectation and the long-term results and expect those to deliver trade in, trade out, because they're not looking at the averages. So what I say to people is, yes, that strategy averages 60% a year, 50% a year, 38% a year. But how many times during that year do you have a drawdown period? Are there 2 periods or 3 periods out of the year where that strategy is losing you money? Because that's the price you have to pay short term to be able to make the money on that strategy long term. And that's understanding the concept of random distribution. So regardless of whether you're a day trader, swing trader, position trader, or as some of our guys in our trading room and our professional members are doing, is they're combining multiple strategies over multiple time frames, is you have to look at the time, energy and commitment that you have to put in, and you have to look at the worst case scenario. So rather than just simply look for a broad stroke of what can I expect to make, ask a better question. Say, what do these strategies have the capacity to make, and what price am I going to have to pay potentially short term to get the results over the long term? Hope that was useful, guys. I will be back again later on in the week. Trade safe. Great to see you all, and I'll catch up with you soon.